Hi, I'm David Schenck. I'm an attorney and enrolled agent, enrolled to practice before the IRS, and I talk about tax issues, estate planning, and asset protection. Today, we're going to talk about discharging taxes in bankruptcy. So can taxes be discharged in bankruptcy? The quick answer is yes. But the longer answer is yes, but only certain taxes, and it can be complicated to figure out which ones qualify. Not all taxes are dischargeable in bankruptcy. Trust fund taxes, which are basically employment taxes, and the associated penalty for failure to pay those trust fund taxes are not dischargeable. Taxes on returns that are fraudulent also are not dischargeable, and the associated penalties. But most individual income taxes can be discharged in bankruptcy. Eventually. It's a lot about the timing. Individual income taxes are only dischargeable after you meet some waiting periods. And there are 3 waiting periods, the first of which is that it must be at least 3 years after the return was originally due. And then it must be at least 2 years after the return was actually filed. So if you file your return on time, the 2-year period obviously is contained within the 3-year period. But if you file your return late, then you have to wait 2 years before you can look at discharging it in bankruptcy. Then the last waiting period that most taxes have to pass in order to become dischargeable is at least 240 days after the tax was assessed. We're going to look at each of these individually. So at least 3 years after the return was due, it includes extensions. So for most years, you're looking at October of that year. But sometimes it can be later, like in some of the recent years, taxes weren't due until June, and then with extensions until December. At least 2 years after the return was actually filed. Right? So for a timely filed return, this period is contained in the 3-year period. But it also means that an unfiled return never becomes dischargeable. If you don't file the return, you never start the 2 years after the return is actually filed clock running, and that tax never becomes dischargeable. Generally, an IRS filed substitute for return, which they will do sometimes where they pretend to file a return on your behalf, does not count as a filed return for bankruptcy purposes. You must actually file the return in order to start the 2-year clock running. And a late filed return obviously has to wait out the 2 years, at least 240 days after the tax was assessed. Generally, a tax is assessed a few weeks after it's filed. And so this is not going to be an issue for most returns because 240 days is less than a year, and it's going to be contained within either the 3-year or the 2-year waiting periods we just discussed. However, in the case of an audit that results in additional taxes due, or in the case of an offer in compromise during which this 240-day assessed period is told, and for 30 days after that offer in compromise is considered, this may be an issue. So these can be tricky to figure out the 240 days after assessment if you've late filed, or you've had an audit, or you're in an offer in compromise situation. So while an offer in compromise is going to suspend the 240-day count, the filing of a collection due process appeal, which is the IRS's internal appeals process, is going to suspend all 3 of the time limits. The 3-year, the 2-year, and the 240 days will all be suspended. Now, that's not usually a good reason to not file an appeal if the IRS is going to levy on your assets, but it's something to keep in mind. And the reason that a collection due process appeal suspends these time limits is because the IRS will not be pursuing collections activities while your appeal works its way through their internal appeal system. And while bankruptcy is one way to handle a completely unpayable tax debt, an offer in compromise can be a better place to start if your debt is largely taxes. The offer in compromise can be less disruptive to your life, your finances, and your credit rating. However, if you have significant non-tax debt in addition to tax debt, then bankruptcy can help you deal with all of your debts in a single process. For most individuals, there are two types of bankruptcy. Chapter 7, also known as liquidation, and Chapter 13, which is also known as a wage earners plan. Let's look at Chapter 7 first. In a Chapter 7 liquidation, you liquidate the equity in all your assets and turn it over to the bankruptcy trustee, who then pays it out to your creditors. And then you're done. Many Chapter 7 bankruptcies are what we call no asset cases, which means that after considering the exemptions allowed under bankruptcy law, which can vary from state to state, many Chapter 7 filers have no assets at all to pay, and the case is closed without any payment being made. But obviously, if there are assets in excess of the exemptions, then they have to be liquidated. Not everyone is going to be qualified for Chapter 7. If you have sufficient income, you may be required to go through Chapter 13. Chapter 13 plans require you to make regular payments to your creditors over a number of years. It does have the advantage that you can generally keep your assets. For taxes, the way a Chapter 13 plan works is that any tax which is secured by an IRS lien has to be paid off to the extent of the equity and property that the lien covers. So for example, if the IRS files a lien before you go into Chapter 13 and you have $1,500 in household furnishings equity and $10,000 in house equity, then your Chapter 13 plan must pay at least $11,500 to the IRS for taxes that are covered by that lien. Unsecured taxes are either going to be treated as priority claims, and these are taxes that haven't met the waiting periods, and they have to be paid off at 100%. Obviously, if you haven't met the waiting period, the tax is not dischargeable in bankruptcy, and so your plan must pay them off in full because they're not dischargeable. Or they're treated as general unsecured claims, and these are taxes for which the IRS hasn't filed a lien and which have met the applicable waiting periods. And these can be paid off at whatever the plan is going to allow. Generally speaking, less than the full value of the tax due. Bankruptcy can be a powerful tool for dealing with tax debt. But like other powerful tools, it can be a little tricky to use correctly. Disclaimer: this video and any accompanying text is for informational purposes only. The information provided does not and is not intended to constitute legal advice. No attorney-client or similar relationship is formed. If you require legal advice, please contact an attorney or other legal professional. This video covers a complex legal area in just a few minutes, and of necessity leaves out much of the detail. Don't make decisions based only on this video.